U.S. stocks climbed to record highs yesterday after President Trump extended the ceasefire with Iran indefinitely. That rally comes as the stock market has remained mostly positive throughout Trump's second term, despite economic volatility around the war and the administration's sweeping so-called Liberation Day tariff hikes last year. Let's bring in former Treasury official, Morning Joe economic analyst Steve Rattner with charts on what is behind Wall Street's positivity. So, Steve, this can be very confusing to people who watch this economy. They see the jobs numbers. They see the huge inflation numbers as well. They see tariffs being placed on goods and services across this country. And yet the stock market continues to march upward. How does that work exactly?
Yeah, Willie, it's a mystery to a lot of people. And in some cases, even people who are professional investors on Wall Street did not predict this kind of surge. But we can take a look at graphically what's been going on. So Trump arrives. We have Liberation Day, which, as you mentioned, was a hit to the stock market. It went down pretty sharply, quite sharply. But then it just marched upward through the whole first year of Trump's term into the second year, right up until the war began. And then it took another little, not so little, dive here. But then it's bounced right back to, as you say, to notching a whole series of all-time highs, which is really quite remarkable. Although when you put this in context, actually, for whatever set of reasons, the last several presidents have had a really good start to their terms in terms of the stock market. Here's Trump 2, all what you see up here, up 16.8% in his beginning of his second term. Slightly below, but very similar to his first term, actually. A bit above Biden, because Biden had to deal with COVID and rising interest rates and a few other things. But then you look at Obama, who came in right during the financial crisis, as we remember, up 49%, up 25%. So history would tell you the beginning of a president seems to go pretty well.
You know, what's interesting, though, Steve, is if you look back over the past 6 years, I guess maybe 4 years, as we were moving beyond COVID, Andrew Ross Sorkin and I always seem to have had the same conversation for the past 4 years, where we kept waiting for economic numbers to go down as interest rates continued to go up, and the macro numbers never did that. As inflation went up, the macro numbers stayed strong for the most part. Inflation went down, interest rates still up high. We kept talking about how resilient the economy was. Donald Trump comes in, all the threats about sort of radical tariff policies, and time again, the market has endured. It's moved forward despite that. As you go to your corporate earnings still being strong, try to square that. Not only what we've seen over the past year and a half with Donald Trump, but also what we saw the last couple of years with Joe Biden, how despite rising interest rates, despite inflation, and now despite tariffs, despite a stubborn 3.3% inflation rate, even now, corporate earnings still stay high in a very volatile economy.
Yeah, that's exactly remarkable. And so thanks for the lead into this chart. But as you can see here, to make your point, Joe, look how strong corporate earnings have been. And you can go back to 2024 when Biden was still president. They were going up. But then toward the end of 24, the rate of growth of earnings accelerated all through 25. And now the analysts are projecting that earnings will accelerate even more in 26 up to these high levels. And if you looked at a chart of the progression of these earnings estimates, you see that analysts are getting more and more bullish. They're actually raising their estimates of corporate earnings. So why is this happening? It's happening for a number of reasons. One of them is AI, which I'm going to talk about right down there in a second. But also, companies are tightening their belts. The weak job market that you mentioned is a function of companies really trying to slim down their workforces, get leaner and meaner, and be ready. You had the One Big Beautiful Bill, which provided some tax relief to companies, and that obviously helps corporate earnings. You have a reasonably strong economy, in part because of AI. And so if you look down here, you can see this is just one proxy, one example of what's going on in the AI world. These are capital expenditures by the so-called hyperscalers, the Amazon, Google, Microsofts of the world. And you can see back in 2020, they were spending about $80 billion. Now they're spending $675 billion, 8.4 times increase in 6 years. And all of this filters through the economy in just more spending. They go out and they buy data centers or they commission data centers. People have to go and build them, creates jobs, it creates profits for the companies that build them, and all that filters back up here. So you've got a combination of tight management by companies, a reasonably strong U.S. economy, the tax relief they got, and the AI boom. And the AI boom is also helping corporate profits because companies are reporting pretty regularly that they're using more AI, and that's making them more efficient. Obviously, we get into the whole question of jobs, but for the moment anyway, AI has been a boon to corporate profits.
Well, I was going to say, all the things you're talking about, whether you're talking about the Trump tax cuts for corporations, if you're talking about AI, if you talk about the belt tightening, which is making corporate profits go up, all of that good news for corporations, most of that really bad news for working Americans. So there are real winners and losers in this economy, aren't there?
Well, as a matter of fact, we have a chart on winners and losers. So we can start with winners and losers among the different industries, because not all industries have participated equally in those profits that I showed you there before, or in their stock market performance, which I will show you here. So if you look at a category which we call consumer staples, this is Walmart, this is Procter & Gamble, this is things people buy just as everyday needs. Those stocks were doing quite well before the war. Since the war, they're down. Why are they down? Because gasoline prices are high and all energy costs are going up. And so the expectation is consumers are going to have to cut back on their spending on these kinds of items. Airlines, probably pretty obvious. Higher fuel costs, not good for airlines. Utilities, similarly. Materials are companies that use a lot of commodities, and commodity prices generally have been going up because of this inflationary situation. And then you have the Magnificent Seven, the technology companies that we talk about, again, the Amazon, Google, Microsofts of the world. They actually had a tough first quarter because Trump put tariffs on them, and you had what was called the DeepSeek moment when it looked like China was going to be successful in AI. But then post the war, coincidentally, all those pressures came off. They're up. And then, of course, oil, you'd expect. They were up before, but oil companies have been up substantially since the war began. So those are winners and losers on the company side. But to get to your point, Joe, you can look at individuals, and you can see that actually individuals for the past year or so have done, on average, and you obviously have a lot of income inequality. I don't want to minimize that. But on average, earnings were running slightly above inflation. So people were getting a little more purchasing power on average. But what happened when the war started, as you pointed out, was inflation goes up, wage increases were drifting down, and so as we sit here today, consumers are really getting no benefit from this economy. They're essentially staying flat at best in terms of their purchasing power. And so when you look at the polls that you guys have been talking about so much over the last few days about Trump's handling of this and that, the economy, the war, and so forth, this has certainly got to have an impact on people's perception of his handling of the economy. They're seeing higher gas prices, well over $4, and they're not seeing their paychecks going up by nearly that much at the moment.
And oil this morning back over $100 a barrel, so those gas prices aren't coming down anytime soon. We'll see. Morning Joe economic analyst Steve Rattner. Great stuff there as always. Thank you.